Ho, ho, ho. Merry Christmas, everyone. Art Collins here with another gift for all the good little boy and girl traders out there. This one is off 135-minute bars. Done some research on those. I like the symmetry of them. When you break the trading days in the S&P futures and other related markets, doing the day session only from 8:30 a.m. until 3:15 p.m. Central Time. You have 405 total minutes in the trading day. You divide that into thirds, you can get 3 equal 135-minute bars. The second bar gives you a signal on what to do with the third. And it works like this. Again, set your chart to 135-minute bars, day session only from 8:30 a.m. until 3:15 p.m. Central Time. There are 3 equal 135-minute bars during that 405-minute day session. And the 3 bars end at 10:45 a.m., 1 p.m., and 3:15 p.m. session close Central Time. So we're going to be interested in what the 10:45 to 1 o'clock bar is telling us. The middle bar is a cue on what you should do in the last third of the day, 1 o'clock on. And it works like this. At 1 o'clock Central Time, go long if the middle bar close was greater than the middle bar open, and the middle bar low was greater than the first bar low. Or, at that time, go short if the middle bar close was less than the middle bar open and the middle bar high was less than the first bar high. So we're operating off 2 signals. In the case of longs, you want a middle bar close that's greater than the open and a low that's greater than the previous or first bar low. For shorts, middle bar should have a close less than the open and a high that's less than that first bar high. And you exit all trades at the 3:15 p.m. close. So we have 3 examples of that here. 2 shorts and a long. 3 days in a row. That's a little unusual, but it does happen, obviously. On this day, the middle bar, trading from 10:45 to 1 o'clock, had a close lower than the open and a high less than the previous high. That gave us a short signal, so we sold here, bought back lower on the close. Second day, middle bar had a close lower than the open and a high lower than the first bar high. So we again entered at 1 o'clock, out on the close. Following day provided a long signal because the close of the middle bar was higher than the open and the low rather was higher than the previous low. This is what we got. From January of 2010 through the middle of 2019, we have something that looks pretty good in the S&Ps. You tripled your money if you would have started out with your worst $10,700 drawdown. $33,000 profit on a single mini contract. $17.60 average trade. This doesn't include slippage commission. Your Dow, NASDAQ, and Russell are moderately good also. At the very least, they're giving us affirmation that the concept is correct. And then you get another bump in the mid-cap, almost as good as the Dow or the S&P. So I would say, all right, not the greatest thing you've ever seen, but if you're looking to diversify your day trading, you have some good signals early on, which you should if you're following my videos. This would be something that would augment it well, okay? Now you have a late trade, 1 o'clock. So, takeaways, market direction in the last third of the day can be anticipated by the activity of the second or middle 135-minute bar. If the middle bar had a close higher than its open and a low higher than the previous low, go long. If it had a close lower than the open and a high lower than the previous high, go short and exit on the close. Keep your eye out for this. Should be out pretty soon. Beating the financial futures market, the almanac, the keys off the original book. And again, happy holidays. Best wishes for trading and otherwise in the new year.